Hi there, welcome once again to the Dukascopy TV studio. I'm Ben Jones. Alongside me from GAIA Capital Advisors is Thomas Saulnier for a soft commodities update. Thomas, once again, thank you very much for coming into the studio.
Thank you, Ben.
Not a problem. Now, I'd like to begin by discussing the impact thus far, or lack of, that El Nino has had on the soft commodities market. Towards the start of the year, it was packed full of news stories predicting ways that it would damage the agricultural sector. But what have we seen thus far?
Yeah, indeed. Earlier this year, El Nino was expected to have a positive impact on prices, as it has been the case for the last two El Nino effects in 2007 and 2009. But the reality is a bit different. It looks like the impact this year is limited, and that's mainly for three reasons. A, stockpiles for most crops are higher than usual, and especially for rice. B, the US production is expected to be strong, both in terms of quality and quantity. And C, farmers have applied some innovative farming techniques, such as bringing forward plantings and use of seed varieties that cope better with dry conditions.
Okay, now I'd like to look a bit more specifically at corn as well. In the US, favourable weather has seen prices fall. They've recently hit four-year lows. Can you talk about whether this is something that we should get used to, that prices will stay low for the foreseeable future, or is it a temporary price drop?
Indeed, corn prices went down minus 17% year to date, from $450 US on January 1st to $370 US this week. We think that the favorable weather in the US has played a major role in such depressed prices. And even last month, the US Department of Agriculture said that the condition for corn crops was at best for the past 20 years, fueling expectation for a bumper harvest. Having said that, we see obviously the corn prices trading in oversold territories, both in absolute terms and relative to other feed ingredients, but we don't expect a rebound anytime soon, simply because corn prices tend to bottom out at harvest time, which come later this year.
Okay, now I'd like to move on and discuss the impact of the geopolitical tensions. Obviously, they've escalated even further since the MH17 flight tragedy. But can you talk about what's been going on over the past few weeks and months?
Yeah, definitely. The Ukraine is among the top producer for crop, and thanks to its port in Odessa, it's the fifth largest exporter of crop globally. So the geopolitical tension in the country should have had an impact on crop prices. The reality is different. We see that the impact so far has been limited. We think that the tension in Ukraine has been offset by strong US and Russian expected production. Moreover, we see that Russians are aggressively selling their production at discounted prices, simply because they need to sell 100 million tons of combined crops, and that's adding downward pressure on prices.
Okay, now looking into the future as well, if the situation does worsen, tensions continue to escalate, what will be the situation for soft commodities?
Yeah, obviously, if the tension continue to escalate, we expect at some point tension to have an impact, especially as crop prices are trading in oversold territory. We see some risk on the upside. But as I said before, I think the crop prices should remain low in the next few months. And that's the reason why we would favor investing in farming company, especially in meat producers, because in a low crop prices environment, meat producers benefit from low crop prices environment, as it means a lower cost of production for them. So I would typically look at companies such as JBS or BRF in Brazil, Australian Agriculture in Australia, or even Sanderson Farm in the US.
Thomas, once again, thank you very much for joining us.
Thank you, Ben.
Not a problem. Thank you very much for watching. That's all from me for now, but make sure you keep clicking back to Dukascopy TV for plenty more updates and exclusive interviews. Goodbye.